Today we're going to cover how to measure brand initiative. I'm Charlie, I come from investment banking and I help companies with GTM from 10 to north of $100 million to cut their CAC, increase their margin and scale profitably. First, I'd like to start with a couple of measuring warnings. The first one is that tracking is not measuring. People say that you can't measure brand because you can't track it, but incremental benchmarks are really clear. So when you look at tracking, multi-touch attribution, for example, the most touch point you're going to see, the most visible touch points are retargeting, brand search, affiliate. When you look at incremental benchmark, the worst performers are retargeting, brand search, and affiliate. And so tracking is definitely not measuring, and it's actually quite the opposite. So the second thing that we need to be very careful is that you should really look at impression with a pinch of salt. I'll give a few examples. So LinkedIn impression, an impression consists of somebody who saw half of your ad a third of a second. It's basically like you're driving 60 miles an hour on a highway and you just have those billboard passing on the side. You don't pay attention to them at all. The other thing also, for example, you have to be careful is Google impression. Only the top impression are important because nobody goes on the bottom of the page to click on the ad. And then lastly, display. Display, you have massive bot traffic and also a lot of pixel stuffing, which means that you have a lot of ads on the same web page, and so you drive a user to that internet web page and then all of those pixels are going to light up. So I'm not saying that you shouldn't use impression. I'll cover a case where we can, but you should be very careful. So the way you can do this is, for example, instead of looking as a target or as a metric, you correlate your impression with something else. We're going to cover this later on. So the lagging and leading indicators. So when you measure brand, the leading indicators are direct traffic, brand queries, share of search, social media mention, and a lot of other things you can do with surveys like brand awareness and so on. The lagging indicators are brand initiative mentioned in self-report attributions, in sales calls, you see a bigger deal coming in, you see a higher win rate, better quality pipeline, and a lower CAC. And so often what I hear is that, well, nobody cares about the leading indicator. We only care about the lagging one. It is absolutely true, but you need both of them. And the reason why you need both of them is because the leading indicator is going to give you an early signal of what's working and what's not. A lagging indicator will never turn green with no leading indicator turning before. And we use the same concept in trading. For example, in trading, you use a lot of leading indicator to find with a certain level of probability a pivot in the market when the trend reverses. The reality is that if you wait to confirm that the trend has reversed with lagging indicator, you're too late in the trade. And the same applies here too. If you wait for the lagging indicator to turn green, you're extremely slow in reacting and understanding what's working and what's not. Plus, because it's lagging, it's much further in the future, signals always dies off over time. And so you can actually have a lot of difficulties to understand really what's driving those differences in the lagging indicator if you only use that. This is a table with a few key stats of leading indicator. And as you can see, you see in the source, you have Hansen's, you have Binet's, you have a lot of key people who actually did a lot of research on this subject. And we have estimation of the impact of those very early indicators. For example, share of search, we see that 5% increase of share of search is a 2 to 3% market share in the next 6 to 12 months. Direct traffic, 5% quarterly direct visit is 3 to 4% quarterly sales later on. And so stats really shows that it is working. Those leading indicators are going to turn up into revenue. Now, does that mean they always turn into revenue? No. But again, as I said, the leading indicator should turn green first before lagging indicator and revenue increase. Anyway, here is a enterprise client use case. I had a big B2C client, and the client launched 2 big brand initiative over the year. And what you see here is their organic brand search, Google and Instagram. So it's a search on Google and search on Instagram together. And when you see in 2024, the client was the leader, but the 2 brand initiatives that they use actually really helped them to have a much bigger share of search over the year. That actually led to a massive amount of revenue later on. This is a recruitment agency that I'm helping. They wanted to understand really what is the impact of their LinkedIn posts. And what we did is that we just looked at the number of impressions they were having through their posts and what kind of posts they were posting. And then we started to just look at Google search queries. And this is what we saw, is that we could very easily link the post with the spike in brand search queries. We could also see that, for example, when they were doing client videos, interviews, the impact was a bit longer. When it was posted, it was mainly a spike and then go down. So this is a leading indicator. As you can see that it's working. You can see it's driving people to your website. Now the lagging indicator will be to confirm that move into the self-attribution, for example. So if you're in a recruitment agency, a real estate company, or anything else really, and you're actually contributing actively to LinkedIn, this is what I would recommend you to do, is that you would look at the search queries happening on Google, and then you could link to your post with that search query. The only caveat, obviously, is that the signal should be much stronger than the noise. So if you have a lot of initiatives running at the same time, it will be more difficult for you to find it, although it's still possible because you can use some linear regression and then you can make sure that the regression makes sense. But what I'm saying is, if you are active on LinkedIn, if you're wondering what is the impact, the first thing you do is that you look in Google search query, and also you can look at your direct traffic, because people are going to click on your website or offer search your website on Google, and then you will have your first indicator that it is working, and then you confirm that trend with self-attribution or self-cause introduction, where you ask, how did you hear about us and what led you to contact us, and so on. Another thing that is working too, that this agency did, is even when they outbound, they saw that there was a better conversion rate, people more open to have sales calls because those people knew the founder who was calling, because they saw him on LinkedIn. Now we're going to talk about Salesforce versus HubSpot. So B2B buyers tend to be risk averse, and so often the bigger brand is always perceived as the safest bet against a contender. The reason is because it's a bigger brand, more people are using it, there's more integration, and so on. And so it's much easier for a bigger brand to sell more than for a contender trying to have market share. What you can see on the left here in the share of search, in 2021, HubSpot has only 8% of the share of search versus Salesforce with 92%. Obviously, there are other CRM companies, but here we only look at queries on Salesforce and HubSpot. But what you can see also is that little by little, HubSpot is increasing. And what you can see too is that this is directly reflected in the stock market price. So over the same time where HubSpot succeeded to increase the share of search from 8 to 12%, you saw the stock of HubSpot increasing by 81%, while Salesforce increased by 31%. So there is a 50% delta for those 5% share of search difference. Now, a stock market price is never like fully correlated with the share of search, and the reason is because stock market prices are priced based on future expected value, not real current value. So sometimes it's oversold, sometimes it's overbought, and so on. But I digress. This is not the conversation today. Well, I hope you enjoyed it. Next time, what we are going to do, we are going to look into branded queries. We're going to look at how we can get these branded search, organic and paid search together, and then we can complete the puzzles, understand what is the level of cannibalization between the two, and so on. It's going to be very exciting. Thank you so much for taking the time today, and I'll see you soon. Bye.